All right, welcome out, ladies and gentlemen. We're going to be talking today about the poor boys covered call. Had a few issues with Zoom this afternoon, so this is going to be pre-recorded for you. But as usual, if you have any questions, you can reach out on our clubhouse or post a comment here. This is Coach Tyler Craig with Untitled Trading. Excited to be here. And I got a lot to talk about. So let me give you the gist, the game plan here of what we're going to cover. So first of all, I'm going to talk about what is a traditional covered call. What are you usually trying to accomplish with a covered call? What are the pros? What are the cons? And then we'll compare that to a poor boys covered call. How do they differ? How are they similar? Why is it called the poor boys covered call? And I'm going to show you a bunch of examples and give you some rules for how to manage the position. All right. So by the time we're done with this discussion, this video, you should have a pretty good idea of exactly what the poor boys covered call is, how to build it, how to trade it, how to put the order in, and then have an exit plan for how to manage whether it goes in the right direction or in the wrong direction. All right. So traditional covered call, you know, if we're going to really understand a poor boys covered call, we first have to understand its predecessor, which is just a typical conventional covered call. So the structure of a covered call is you buy 100 shares of stock and you sell one call option. When you sell a call option, you are promising to sell the stock and you're getting paid. So essentially you're getting paid for a promise to unload your stock at a specific price. Why would you do that? Why would you do that? Well, if you think about it, the con here is you have limited reward. It limits your profit potential. And so what we're going to do is we only use this when we're maybe neutral to mildly bullish. Obviously, if you're really, really bullish, if you think something's going to pull a Tesla and just go crazy, you probably don't want to sell a covered call. Maybe you just want to buy stock. So your outlook, your bias is neutral to mildly bullish. At Untitled Trading, we have a number spectrum to kind of illustrate that. And the spectrum is -3, -2, -1, 0, 1, 2, 3. And 0 is neutral, 1 is mildly bullish, 2 is moderately bullish, 3 is aggressively bullish. So this is like a 0-1 type strategy, okay? 0 to 1, neutral to mildly bullish. All right, so drawback number one is it's limited reward. A second con would be it's expensive. It's expensive because you have to buy 100 shares. Got to buy 100 shares. What are the benefits? All right, let's go through the pros real quick. Why does somebody sell a covered call? The first benefit is you generate income, so you get paid. Okay, and that could be a payment you get every month if you're selling monthly covered calls. So we could say monthly income or cash flow potential. You're selling a call and bringing in money that you otherwise wouldn't have received with just stock ownership. At the same time, you get some downside protection. So if I sell a covered call for $100, I can lose up to $100 in the stock and still break even. So it gives me a little bit of a buffer month to month against small losses in the stock. All right. I would say that the biggest hurdle for people in covered calls is the cost. So of all of the disadvantages or drawbacks, which there's really not that many, but the biggest argument against the covered call, or the biggest, it's not really an argument, the biggest reason why people don't do it or don't like it as much is because you got to buy 100 shares of stock. And so what we try to do with a poor boys covered call is we say, how can I build a similar position with similar reward, similar profitability, some similar probability of profit or profit range? How do I build something that walks like a covered call and talks like a covered call, but is much cheaper? Because if I'm poor, if I'm a poor boy and I want to get access to those advantages that are embedded in a covered call, but I don't have the money to buy 100 shares of stock. Is there an alternative? Is there something else I can do to get pretty much the same advantages at much, much lower cost? And the answer is yes, there is something you can do. It is a poor boys covered call. So if you've learned about a covered call or heard about a covered call and you want to reduce the cost, okay, or you're interested in a lower cost way of doing that, because maybe it's a more expensive stock, maybe it's a $150 stock that you want to do a covered call on. That's $15,000 in a cash account. Maybe you want to build a similar position for $1,000 instead of 15,000, right? So it could be it's a more expensive stock that you want to build a covered call type position on. It could also be simply that you have a smaller account, and to do any kind of position like this, it's got to be the cheaper variety, which in our case is going to be the poor boys covered call. Okay, so how do we do this? Well, when you think about the structure of a traditional covered call, step number one is you buy 100 shares of stock. And when you think about that from an options Greek perspective, you have a delta of positive 100, okay? So you make $100 if the stock goes up, you make 100, or you lose $100 if the stock goes down. The second step is you're going to sell one call option. And typically it's like a 1 month call, short term to take advantage of the higher rate of time decay. And typically it's slightly out of the money so that you can profit on the stock a little bit before you've got to sell it. So what we're going to do with a poor boys covered call, step 2 is going to be the exact same. Okay, step 2 is going to be the exact same here. The difference is step 1. You were not going to buy 100 shares of stock because it's too expensive. The question then is, what can I purchase that walks like stock and talks like stock, but is a lot cheaper? Well, a call option moves kind of like stock. Okay, it mirrors the stock behavior, in other words, and specifically look at the delta. The delta of stock's 100. Could I buy a deep in the money call that has a delta of 100? Would that effectively replicate a long stock purchase? The answer is yes. The answer is yes. You could just buy a deep in the money call in lieu of buying stock, and it's going to be a lot cheaper. Now here in a minute, I'm going to show you why you don't need to buy a 100 delta, okay? We're not going to buy that deep in the money, but let me just do a compare contrast here for a second. So I'm going to bring up Thinkorswim, and we're going to build a poor boys covered call. I'm going to do this on gold. Gold, gold's been going crazy lately. I don't know that this is the best entry point, but I will tell you that historically, covered calls on gold just aren't that exciting because gold volatility, even though it's pretty high right now, historically gold implied volatility has been pretty low, which means its options are relatively cheap. So trying to generate a really good return selling a covered call on gold, you can get a decent return. It's not great. It's not great. And so maybe I do a poor boys covered call. Because it's cheaper, the return on investment is usually a lot higher. Okay, this is a new point. A traditional covered call, maybe you make a 2% return, maybe a 3% return, maybe a 4% return. Okay, if it's a really volatile stock, maybe a 5 or 6% return on a covered call. You're not making a 15% return on a covered call typically. Okay, 2, 3, 4, 5%. A poor boys covered call will double or triple that. So instead of getting a 3% return, you might be getting a 10% return. Instead of getting a 15% return, you may be getting even a 20% return. So we're going to supercharge the return of a covered call using that poor boy variation. So let me do an example here. So we've got gold, and we're about 23 days out from August. I'm actually going to go to a 30-day option, and I'm going to build just a traditional covered call trade. So I want to sell anywhere between 30, 40 delta, somewhere around there is going to be the covered call strike price that I sell. In this instance, I'm going to go with about the 37 delta. I think 43 is a little too high. You could also sell the 30 delta if you wanted to. let's go with the 37 delta. I'm going to right click, and actually let me do it this way. I'm going to buy 100 shares of stock, okay? And then I'm going to sell this 190 call. So that would be the 2 steps of the covered call. If I wanted to put those together, I would just right click and do buy covered stock. Okay, covered calls have synonyms. Some people call it a covered right or a buy right. Thinkorswim refers to it as a covered stock position. Same thing. Okay, same thing. So when you put these 2 together, it costs you about $181.78. Okay, if I right click and analyze and then delete my other sections here, this is the risk graph, okay? The visual depiction of the potential profit and potential loss of the covered call. And in this instance, my max profit's about $822. You can see that down here, 822 bucks. So let's put this actually in the notes. I want to write this out. So the gold covered call, traditional covered call here, we're long 100 shares and we're short the AUG. This is a 30-day, I think it was the 190 strike. The 190 strike, and I believe that was around $3.30 is what we sold it for. Let's double check here. $3 and call it $3.25. Okay, $3.25. Okay, so that's so my net debit is 181. You can do it. There you go. 181.76 is the net debit. Max reward, looking at the risk graph, max reward is about 822. Okay, 822 bucks. So your return on investment, you're making 822 on 18,176. 822 on 18,176. That's a 4.5% return. Now I led with, cover calls on gold aren't that great. This is actually a really good cover call return on gold. The reason in this example it's pretty decent is because gold implied volatility is high right now because of the big breakout we just had. There's a lot of demand for gold options. So you can actually get a decent ROI. This is not typical though. If you go back 6 months ago in GLD, you probably would not get a 4.5% return selling a 37 delta 1 month covered call. Okay, so I would say this is a optimistic example. Now, the biggest hurdle for most people here is the cost, 18,176. In a margin account, you'll only have to put up half of that, but it's still $9,000. So how can we build a cheaper variant of this, a poor boys covered call? Well, I'm going to do the same thing as step 2. Okay, so here's my poor boy. So I'm not going to go long 100 shares. I'm going to go long an in the money call. Okay, and then I'm still going to sell that August 190 call for $3.25. So that part doesn't change. That part doesn't change. What changes is what am I purchasing in lieu or instead of the stock. So I'm going to buy an in the money call. Now, how far out in time you go really depends on you. Okay, it depends on you. In this case, I don't want to go out like a year. I don't want to even go out 6 months. I just want to go out a couple of months. Suppose that I know I want to sell a cover call for August and September. I know I at least have the next 2 months to sell cover calls. So I'm going to go out to October. I'm going to buy an October in the money call. And then I'm going to sell August initially with the intent of potentially selling September as well. So I'm basically buying a 3-month in the money call. And I'm selling 1 month out of the money calls against it. Now, if I use the delta column, if I wanted to mimic buying 100 shares of stock, I would buy a 100 delta call, deep, deep in the money. But what you'll discover is they're really expensive. Okay. Now in this case, 98 is close enough to 100. So let's just go with the 130 strike. I have no clue why it goes from 130 to 24. I don't even know if these actually trade, to be honest. But the 130 looks like it's a legit option. So delta's basically 100. You're paying $55. Now $55 is better than 181. It's still cheaper than buying the stock. So if you wanted to, you could buy almost 100 delta call, and you could go sell. In this case, we were selling the 190. So you could sell, we'll just go here. I could sell the 190 against that. If I did them at the same time, I just hold the control key and click on the one I want to sell, and it adds it to my long call and creates a spread. So this would be $52. $52. Now let's compare contrast here. Just want to analyze. This was the traditional covered call. Cost me $181.78. I can make $822. Here's the poor boys covered call. Cost me $52 instead of $181. And my max profit is close to $822. It's about $802. So the same upside, essentially the same risk graph, but my cost goes from 181 down to $52. Okay, it's about a third of the cost. And so if you look at making that $802, mess that up, $802 on 52, that'd be $5,200. Now that's a 15% return. So I just took a regular covered call offering about a 5% return, and all I did was substitute buying the stock with buying a 3-month, essentially 100 delta call. And I took the return from 5 to 15%. That's pretty good. That's pretty good. I'm going to go one step further, but this, even if you just do side-by-side comparison, long 100 shares versus buying essentially a 100 delta call, because the 100, or in this case, the 99 delta call was a third of the price of the stock, it tripled the ROI. Going one step further, you'll discover you really don't need to go all the way down to 100 delta. It turns out that buying like an 80 delta call is close enough to 100 to behave like stock. An 80 delta call is a good enough stock substitute to be able to sell covered calls against and still create a risk graph that looks like a traditional covered call. So this time, I'm just going to go to the October, same 3 months out. I'm going to go to like an 80 delta, which is $17. Buy that and sell the covered call against it. Okay, I don't know if you guys can hear that banging. I got a bunch of hoodlums upstairs. 30 delta or 30 days out. So I'm going to sell this 30-day 190 strike. Same. I guess it's a 37 delta. So we have not changed step 2. I haven't changed which call I'm selling. In all of these instances, I'm selling a 30-day, around 37 delta call. Okay. But here, because I only bought an 80 delta on the one that I was purchasing instead of a 100 delta, the cost is about $14. Okay, so let's take a look at this one now. Now, you'll see I've got 3 positions modeled here. The first one, this is the traditional covered call. The second one was my like perfect equivalent position, my perfect synthetic position where I bought a 100 delta call and sold the covered call against it. The third one is the cheaper variant where I'm only buying an 80 delta call. Okay, and what I want to see is, does the risk graph look close enough to the covered call where I can effectively view it as a covered call substitute, a poorer version, a cheaper version of the covered call. When I look at this risk graph right here, this looks pretty darn similar to the other ones. Okay, so let's see. This was the traditional covered call, buying the stock, selling that 1 month out of the money call. Again, just picture this in your mind, and I'll even take out this shaded area so it looks more clean. This was the perfect equivalent position of the covered call. And this one's the cheapest variation. looks similar. I went from $181 of cost to $52 of cost to $14 of cost. Okay, so now I've really ratcheted down the cost. I wonder what I did to my return on investment. When I went from the traditional covered call to the perfect synthetic, I tripled the ROI. Now I've taken the cost down even more dramatically. Let's see. First of all, the maximum reward is no longer $820 bucks. Okay. So one of the side effects of buying an 80 delta call instead of a 100 delta call is I don't make as much money. But I think what you'll discover is the small amount less profit is dwarfed by the massive reduction in cost. So it's like I reduce the cost this much, I reduce the reward this much. Okay. And when you reduce the cost of a trade this much and you only reduce the reward this much, what that does is it really supercharges your return on investment. Okay. So no, I can't make 820 bucks anymore. I can make about 640. Okay. So I did chip away a little bit at the potential profit, but I took the cost from 52 now down to 1,400. If I take the profit divided by 1418, now my ROI is 45%. 45% ROI. Okay. That's a poor boy's covered call. I created virtually an identical risk graph to a traditional covered call at much, much lower cost. And so I took the ROI from like 4.5% to 45%. I just took it up like 10x. I just took it up like tenfold. Okay, so that third one would be, to me, my typical approach for a poor boy's covered call. Okay, I'm not usually buying. I don't honestly, I don't really know anybody. Maybe I need more friends. I don't know anybody who buys 100 delta calls. Usually around an 80 delta is close enough as a stock substitute. Okay. So let's put these numbers in the note here, and as I write it out, this will just be a nice little review for you. Okay, so for the poor boys covered call here, okay, the perfect synthetic was we went long a 100 delta call. It was basically 100. Okay, and then we shorted the AUG 190 call. And then the typical, or I guess the usual, let me say it this way, changing this as we go. The commonly structured poor boys covered call would be long like an 80 delta or thereabouts, and then short that same 1 month out of the money call. So what we did here is we bought the October 170. Okay, so this was the October 170. We bought the October 170 call, sold the AUG 190 against it. The more perfect synthetic, we bought the 130 strike. We bought 40 strikes or $40 further in the money. So here we bought the October 130 call. That's what made it so much more expensive. So 52 bucks. So the net debit here, let's fix that. The net debit here was about $52. Okay, and then the net cost on the one that I would do was about $14. Okay, and I think this visual right here is probably the best way to stack them up. This is your covered call versus perfect synthetic versus how I would typically position it. Take a little snapshot there. And we'll post it here. Okay. And again, you can almost guess and check on this a little bit, because the proof is when you look at the risk graph. The proof is when you look at the risk graph. It should look somewhat like a covered call risk graph. So as I go from a real covered call to a perfect synthetic to then a more traditional poor boys covered call, do you see much change in the graph? I don't. This is the you know, the final version here. So 14 bucks, gold keeps going up. I make 600 bucks. What if it goes down? Well, you lose money. I mean, in all three of these cases, these are bullish trades. You're going to lose money if the stock goes down. The difference is how much you lose. The difference is how much you lose. Okay. Hang on. I got a couple monkeys on the piano up there. I text the boss here. Trying to be a professional. Give me a break. All right. So that's how you build it. That's how you build it. Let's talk about management for a second. Okay. Let's say that I went with this October, August, poor boys covered call. Okay. Now I'm not making a comment. I'm not making an argument that this is a great entry point for bullish trades in GLD. There's no doubt that it's a little bit overbought. Okay. I'm just using it as an example to compare how much it would cost for a traditional versus a poor boys. Whether you pull the trigger or not right here, I mean, I don't have a strong opinion with that. But let's assume you do. Okay. Let's assume I come in, I build out this trade. I bought a longer term in the money call, short term out of the money call, 14 bucks. What's my trade management here? What's my trade management? So I want to clarify the trade management. And then I actually want to take a step back and say, if the poor boys covered call delivers 10 times the potential return, and by the way, think about the correlation here. I think there's a math lesson. The original covered call was like 180 bucks. The poor boys covered call was 14 bucks. I basically reduced the cost by like 90%. So the poor boys covered call, let's make the math easy. The poor boys covered call was 1/10 the price of the regular covered call. So if it has the same return, if you take the cost and you drop it 90%, or the new cost is 1/10 the price of the old cost with the same return, your return's 10 times better. Your return's 10 times better. Now, the math isn't perfect because in reality, the dollar amount of the gain is a little less on the poor boy at 650 bucks instead of 800. But that's pretty similar, right? If I can get a similar return at 1/10 the cost, I'm going to have like 10x the return. If I can get a similar return for half the cost, I double my return. Similar return for a third of the cost, I triple my return. So, it's linked in that manner. So if the if the poor boys cover call delivers maybe 5 times to 10 times the potential return, then why would I do a covered call? Like, why would I do a traditional covered call? This is a super common question that I get. It's like, well, gee, I mean, why wouldn't I take that potential 40+% return with the poor boys? Why would you do a covered call? There's a couple of reasons why I still do covered calls, even though when I look at a synthetic version using the poor boy, it seems like it's way better. One reason is maybe I already own the stock. Okay, I'm not going to sell every stock I own and replace it within the money calls because I know a poor boy's covered call. Why? Well, because the call options have expiration dates. Maybe I don't want to have to keep buying call options every couple of months to keep the trade going. I only have to buy the stock once, and then I can sell covered calls every month for the rest of my life. If I do the poor boy, I got to keep buying calls. Okay. Now that's not a very strong argument, by the way. It's like, oh, boo-hoo. Every 3 or 4, 6 months, you got to buy another call option. That's not a strong argument, but it is an argument and it is a fair point. Okay. Maybe I already own the stock. I've already committed the capital. And I don't want to sell the stock and replace it with calls just because it's more management. Okay. Maybe I want to invest a lot more money. So 100 shares of GLD is about $18,000. One poor boys covered call is about $1.4 thousand. Okay. And so it's super cheap. Well, what am I going to do with the other $16,500 if I do one poor boys covered call on gold instead of having $18,000 in gold? you know, maybe I don't have a home for that other 16,000 bucks anyways. Okay. I'm certainly not going to do 10 poor boys covered calls instead of one covered call on gold because it has 10 times the leverage. Okay. And if you start doing that, you can get yourself in trouble. Now, admittedly, if I had a smaller account, I may look on this and say, you know, I'd rather only tie up 2,000 bucks in a trade versus 18,000, because then that frees up a lot of money to do other positions, to do other trades. Okay. But look, if you have a bigger account, that's not an issue. So how appealing this is, I think depends on what's your account size. Okay. There's a lot of people out there that have large accounts and they're not really worried about tying up 18,000 bucks in one position or 15,000 bucks in one position. And if I said, hey, you can kind of do the same thing with 2,000 bucks instead, they'd say, okay, great. But you know, what am I going to sit in cash with the rest? I mean, I got nothing else to do with it. Why not park it in the cover call? You know, it's a fair point. It's a fair point. Another reason why you may do the cover call anyways is I want the dividends. I want the dividends. You don't get dividends with a poor boys covered call because you don't own the stock. Okay. I think the most compelling argument with a poor boy would be somebody comes in, they have a $5,000 account or they have a $10,000 account. They're like, look, I'm not going to be able to do a cover call. Let's just start with that. I'm not going to buy 100 shares of stock. But I really like the risk graph of a cover call. I really like the potential profit, the payout, you know, the high probability, making money if the stock goes sideways. I like all of those advantages of the cover call, but I can't buy 100 shares because I have a small account. What would be a good alternative? Poor boys cover call. Boom. Okay. I think in that situation, it's a slam dunk. Okay. I also think that if you have a large account, you may still use poor boys covered calls just as a trading strategy. You may say, look, I'm neutral to mildly bullish in gold. I don't want to buy 100 shares and do a cover call, but I'll do a poor boy. You know, so you use it more as like a tactical strategy when you're neutral to mildly bullish, versus, hey, I'm going to do this and do it every month for the next 10 years instead of a cover call. Maybe it's a short-term, tactical trade. Okay. All right. So anyways, that's a common question I get, and there's your answer. Final piece here. I don't want this to be a 3-hour video. Final piece, trade management. So let's say I did do this gold poor boys covered call and the stock craters. Okay. So stock drops. What do you do if this is your position? Well, I mean, the first thing you could do is you could exit if we break major support. You don't need to reinvent the wheel. I mean, what would you do with a covered call? What are your rules for managing a covered call? You could kind of apply that to the poor boys covered call. If one of your rules for a traditional covered call is get out at the stock break support, you could do the same thing here. So if we break major support, I don't know, what is that for gold? I mean, you're pretty far off of support right now, but maybe the 50-day moving average. Maybe you say, hey, if it breaks the 50, I want out. Okay. I mean, you could do the same thing here. It's about 166 bucks. I mean, with this poor boys covered call, if I get out at 166, I'm down about 860 bucks. Maybe that's my exit. Okay. You could just get out. What else could you do? You could roll down the short call. And so right now, this is what I do in covered calls. You know, if I originally sold a 190 covered call and the stock drops down to 175 and that call's not really worth anything anymore, I'd buy it back and maybe sell a 185 call. Buy it back, maybe sell a 182 call. You know, I can keep selling calls, buy it back when I make most of my money, sell another one, buy it back when I make most of my money, sell another one. If the stock tanks, your call is going to lose value a lot quicker, the short one. Well, they both lose value, but the short call losing, going down to 30 cents, 20 cents, 10 cents. Maybe you buy it back and sell a new call with more premium, which would be a lower strike. Okay, if the 190 call doesn't have any value, then to sell a new call that does have value, you got to go down. You got to go from 180 lower. So maybe you follow up and you sell new calls against your long-term call. Okay, probably one of those two. Maybe both. Quite frankly, maybe both. If the stock stagnates, you could just hang out, right? You could ride close to expiration. and buy back the short call when you make most of your money. You capture most of the premium and sell another one. So when you look at the risk graph, here with gold, if I move time forward, right now we're break even, okay? If I fast forward a week, 2 weeks, 3 weeks, 4 weeks, now I'm up 175 bucks. Stock didn't move. Okay, well, you were making money because of time decay. And so if the stock doesn't move, you got to give it time to bake in the oven a little bit, okay, and get yourself some profits. So let the time decay chip away at the value of the option. Best case scenario, stock rises, all right? If the stock rises, you're making money due to time decay and due to delta or the price increase. I would typically ride close to expiration. And you don't want to be assigned in this situation. I want to close out my short call before expiration if it's in the money. So ride close to expiration and maybe consider exiting the short call when there is little to no time value. And you can decide if you want to sell another covered call for the next month. Your tip here is if you're using a risk graph, when the purple line, that's today's risk graph, gets close to the expiration risk graph, when the purple gets close to the blue, that means all the time values run out. So if this thing were sitting up at 190, I'm up 400 bucks today, but at expiration, I'd be up 650. There's still 250 bucks of time premium. All else being equal, if I just wait another week or two, I'll make another 200 bucks if the stock doesn't move. So assuming your outlook stays neutral to bullish, your incentive is kind of to ride close to expiration. I don't mind if my call goes in the money. I'm going to be making even more profits. So if I'm satisfied with the max reward, I don't really worry too much if the call goes into money. I'm just waiting until I get close to max profit, and I'll close out the trade or buy back the August option and sell September. Okay. So really, unless the stock tanks, you're usually hanging out for a few weeks until you get closer to expiration. All right, so there's your quick rundown on trade management for the Poor Boys covered call, and I think that gives you a pretty good introduction. I will do one more real quick to send us off. So I use GLD as an example there. For the next one, let's take a look at Apple. Let's take a look at Apple. Really expensive stock, 380 bucks. You want to do a cover call on Apple, it costs you $38,000. You sell around a 35 delta covered call. You bring in 700 bucks, but you're still paying, 37,000. This is what a traditional covered call would look like on Apple. Okay, selling a 30-day, about 35 delta call can make about 2,000 bucks, which seems fantastic. Okay, 2166 is my max profit, but I had to pay 37, let's try again, 37, sorry, I hit number lock, 2166 divided by 37334, 5-6% return on a covered call on Apple. Why is that so high? Because Apple has earnings. So the call premium that I just sold is juicier than normal because I'm selling a call that expires after this week's earnings. I bet on a typical covered call in Apple, you don't get a 6% return. I bet it's more like 4%, 3% maybe. But it's expensive. Okay, so what could I do? Well, I'm going to do a traditional or a Poor Boys covered call instead. So I'm still going to sell the same 35 delta call, but I'm going to go buy an October 80 delta call instead of buying stock. So I'm going to go buy an October, this one's close enough, 79 delta. I'm going to buy that guy. It's going to cost me about $40 for this trade. Still expensive, 4,000 bucks, but it's not 37,000. It's not 37,000. Here's the risk graph of the traditional covered call. Here's the risk graph of the Poor Boys covered call. Those guys look pretty similar to me. The Poor Boys covered call can make about 1640. It's a little bit less than the traditional covered call, but the cost is way less. I took the reward down this much. I took the cost down this much. And that really supercharges my ROI. I can make 1640. I put in $4,000. Essentially, it's a 40% return. I just took a traditional covered call that's like a 5-6% return, turned it into a 40% potential return. How? I just substituted buying a call option for buying stock. That's all. Similar risk graph. Okay. In both instances, you're going to lose if the stock goes down. But with a poor boy's covered call, you lose less. In both instances, you make money if the stock goes up. It's just from a return on investment perspective, the poor boy's covered call is way higher. Okay. All right. That's my video for today. Thanks for hanging out. Hope that gives you a better idea of how the poor boy's covered call works. We'll see you in the next video.